Every year, millions of Americans dread tax season, and for good reason. Whether you're filing as an employee, a freelancer, or a small business owner, taxes can be complicated, confusing, and costly when mistakes are made. Some errors might seem minor at first glance, but they can lead to penalties, missed refunds, and audits that could cost you thousands of dollars. Even experienced taxpayers are guilty of making simple missteps that reduce their returns or increase what they owe. The worst part, many of these tax blunders are completely avoidable with just a bit of knowledge and preparation. In this video, we'll break down 10 of the most common and costly tax mistakes real Americans make each year, so you can avoid them and keep more of your hard-earned money. 1. Forgetting to report all income. One of the most common mistakes taxpayers make is failing to report all their income. This often happens with side gigs, freelance work, or income from platforms like Etsy, Airbnb, and Uber. The IRS receives copies of 1099 forms from these sources, so if you don't include this income in your return, it's only a matter of time before they flag it. Many people assume small side earnings won't be noticed, but unreported income can trigger audits, penalties, and interest. Even if you don't receive a 1099, it's still your responsibility to report all earnings, no matter how small. 2. Claiming ineligible dependents. Many taxpayers mistakenly claim people as dependents who don't qualify under IRS rules. This includes adult children who earn too much during the year, elderly parents who don't meet support requirements, or friends and roommates. Claiming an ineligible dependent may lead to your refund being delayed, adjusted, or denied altogether. Worse, if the dependent was also claimed by someone else, it can create a messy dispute. Always double-check dependency rules, especially for tax credits like the child tax credit or earned income credit, to make sure you're in the clear. 3. Overlooking valuable tax deductions. Missing out on deductions is like leaving free money on the table. Taxpayers often forget to deduct things like student loan interest, medical expenses, home office costs, or job-related education. Even simple deductions, such as charitable contributions or mileage for volunteer work, can significantly lower your taxable income. Many people don't keep adequate records, so when it comes time to file, they can't back up their deductions and end up skipping them. Keeping organized receipts and documentation throughout the year can help you maximize your return and avoid costly oversights. 4. Filing with incorrect personal information. It might sound trivial, but simple mistakes like misspelled names, wrong social security numbers, or outdated banking info can delay your refund, or even cause your return to be rejected. These errors often occur when people rush through their filing or use outdated information from previous years. The IRS relies on this data to match your return to their records, so even a minor mistake can cause major issues. Always double-check your personal details before submitting your tax return to ensure accuracy and avoid frustrating delays. 5. Missing the filing deadline. Missing the April tax deadline without filing an extension is a costly mistake that leads to late filing penalties, interest charges, and added stress. If you owe taxes, the failure to file penalty is significantly higher than the failure to pay penalty, making it crucial to at least submit something on time, even if you can't pay the full amount. Many people assume they won't be penalized if they're due a refund, but if you wait more than 3 years to file, you lose the right to claim that refund entirely. Mark your calendar and don't procrastinate, filing late can get expensive fast. 6. Taking early retirement withdrawals without understanding the tax impact. Withdrawing money from your retirement accounts before age 59.5 might seem like a quick fix in a financial emergency, but it comes with major tax consequences. Not only do you have to pay regular income tax on the withdrawal, but you'll also be hit with a 10% early withdrawal penalty. Many Americans make this mistake without realizing the full cost, draining their future savings while racking up a hefty tax bill. Unless it's for specific exceptions, like a first-time home purchase or medical expenses, early withdrawals should be a last resort. 7. Ignoring state tax obligations. A surprising number of taxpayers focus solely on their federal returns and forget about their state tax responsibilities. Each state has its own rules, and failing to file state taxes, or incorrectly reporting income in multiple states, can lead to penalties and collection actions. This is especially common among remote workers, digital nomads, and people who moved during the year. You may owe taxes in more than one state, and failing to account for that can cause trouble down the line. Always check the state requirements where you live and work to avoid double taxation or surprise bills. 8. Misclassifying workers or side hustles. If you run a small business or hire freelancers, misclassifying workers as independent contractors instead of employees can lead to massive IRS penalties. Similarly, individuals who do gig work sometimes fail to treat their side hustle as a business and miss important deductions. Or worse, don't file the proper forms. The IRS pays close attention to these distinctions, and getting it wrong could result in back taxes, fines, and even audits. Whether you're hiring or hustling, make sure you understand how classification affects your tax obligations and reporting requirements. 9. Failing to adjust withholdings after life changes. Major life events, like getting married, having a child, starting a new job, or buying a home, can significantly affect your tax liability. However, many people forget to update their W-4 form with their employer after such changes. As a result, they may end up withholding too little, leading to a surprise tax bill, or too much, giving the government an interest-free loan all year. Self-employed individuals are especially prone to underestimating their quarterly tax payments. Regularly reviewing and adjusting your withholdings ensures you stay aligned with your actual tax responsibility. 10. Relying too heavily on DIY software without understanding the rules. Tax software is helpful, but it's not foolproof. Too often, people rely entirely on tax programs without truly understanding the prompts or the consequences of the answers they give. These tools can't catch every nuance in your finances, and they don't replace human judgment or knowledge of tax law. DIY filing is a great option for simple returns, but if your situation is more complex, or if you're unsure about anything, it's worth consulting a professional. The cost of hiring a CPA may be far less than the price of making a costly mistake on your own. Taxes may never be anyone's favorite task, but avoiding these common mistakes can save you a lot of money and stress. Most of the errors covered in this article stem from rushing the process, not keeping good records, or simply not being aware of the rules. The key to a successful tax season is preparation, organization, and knowing when to ask for help. Whether you're a W-2 employee, a freelancer, or a small business owner, taking time to learn from the costly mistakes of others can protect your refund and keep you out of trouble with the IRS. With a little effort and awareness, you can file with confidence, keep more of your hard-earned money, and stay on the path to financial stability year after year.